Now let's talk about making your money grow faster than inflation. Because spotting trends is step one. Profiting from them is the advanced move. Your weekly tracker just showed you the storm clouds. Time to build an arc. Investing like a coffee farmer. Coffee farmers play financial chess with the markets while you stress about rising prices. They've used simple tools to protect themselves for decades. Here's how to copy their moves in your portfolio. Farmers use futures contracts to lock in prices, and you can hedge inflation similarly with government-backed securities. Series I savings bonds adjust rates every 6 months based on CPI data, currently paying 5.27%, triple most savings accounts. Tips: Treasury inflation-protected securities work even better. Their principal rises with inflation. A $1,000 tips becomes $1,050 when inflation hits 5%, preserving buying power. Tips saved our retirement last year, says planner Marcos. While friends complained about inflation, our portfolio grew with it. Just as farmers diversify crops, balance your portfolio with commodities and real assets. The Invesco DB Agriculture Fund, DBA, tracks coffee to cattle. When food prices spike, so does your investment. Farmland platforms like AcreTrader offer 11% average returns with low stock correlation. My $5,000 coffee farm investment now covers my actual coffee habit, laughs investor Derek. REITs like Avalon Bay act as rent hedges, increasing payouts as housing costs rise, often yielding 4 to 5%. Coffee cooperatives pool risk, and your 401k should too. Dividend aristocrats like Coca-Cola pass costs to consumers, growing that 3% yield as prices rise. They're inflation ninjas, says investor Sarah. They quietly give you raises. Similarly, pipeline stocks like Enterprise Products Partners collect inflation-linked fees while paying 7 to 8% dividends. Analyst Ryan calls them toll roads for energy. Farmers stay liquid for market dips, and your emergency fund is dry powder. When inflation tanks prices, buy quality at discounts like 2022's bargains. Coffee traders hedge currency risk, just as you should diversify globally. Even 20% in foreign markets cushions U.S. inflation shocks. The Colombian peso trick works for you too. Swiss francs historically rise during inflation spikes. Advanced strategies mirror coffee options. Farmers use put options as price insurance. You can buy SPY puts to protect your portfolio. Floating rate notes adjust quarterly. ETFs like FLTR pay more when rates rise. Inflation swaps let institutions exchange fixed for adjustable returns. You can mimic this by shifting bonds to tips and savings to I-bonds. Coffee economics reveal hidden winners. Freeport-McMoran profits from copper price jumps. Mosaic from rising food costs. Caterpillar from infrastructure spending. ESG investments act like fair trade certifications. Sustainable funds lost less in 2022's turbulence. Agtech stocks like Deere & Company help farmers boost yields, just as their smart tools can hedge your portfolio. Farmers calculate true costs including shipping and storage. You must account for taxes and fees. That 8% return becomes 5% after inflation. The key lesson? Farmers think in cycles, knowing bad years end. Stay disciplined. Keep buying through downturns. Time smooths volatility better than timing. Adopt these inflation-aware habits. 1. Automatic I-bond purchases each paycheck. 2. Dividend reinvestment. 3. Monthly rebalancing. 4. 5% minimum in commodities. Coffee farmers don't predict perfectly. They prepare relentlessly. Your portfolio should do the same. Now for the question haunting every investor. Will prices ever truly come down? The answer might surprise you. The new price normal. That $3 latte isn't coming back. The inflation we've seen isn't a temporary spike. It's the new baseline. Here's why your coffee costs will stay high and how to deal with it without going broke.